right. Well, welcome back.
Welcome back.
Yeah.
From
vacation.
From vacation. Where'd you go on vacation?
I was in Arlington.
Arlington,
Yeah, it's
Texas.
a beautiful suburb of Dallas.
Or Arlington, Virginia.
No, Arlington, Texas.
You should be more specific.
Beautiful.
It's beautiful.
Beautiful.
What's so beautiful about
it? Sports. If you like sports.
The sports are beautiful.
Yeah, there's a lot of sports being played there. It's where the Rangers play and
New York
Dallas
Rangers.
Cowboys, who didn't do too hot this year.
No,
I'm acting like I'm a huge sports guy.
I want to hear the rest of your analysis.
Yeah. Anyways,
keep going.
We'll keep it moving. I don't know. This is cool. Cool news. We got some new swag.
Do we?
That I'm pretty proud about.
We do have some new swag.
You saw our mugs.
We got these fancy mugs.
Yeah. So now we got some,
which totally don't have whiskey in them.
It's water. It's not. Yeah. And then we also got some cool hats.
Whoa.
So
look at that.
I'm just gonna sport it.
Are you gonna sport it?
Yeah.
Am I sporting it too?
You should. If you have any pride in what you do,
dude.
So
I bleed.
It's kind of got like it's like no cap, but it's a cap. So what does that mean,
dude?
Okay, I'll just
that was.
I'll remind the rest
of
the episode. I'm proud of it.
I'll go get that in a few, but
that's okay. You don't have to.
I do really like the hats.
Yeah, they're cool.
They're really nice, man.
They're cool.
I heard that you designed them. Is that right?
No, we had professional designers. Don't be silly.
Okay.
So yeah. Let's talk about some real estate
already.
Or we could just talk about the hats.
I thought you missed me, man.
What are you talking? I saw you yesterday.
I didn't see you all 2024.
Okay.
I didn't see you at all. In December, you were gone.
Yeah.
My heart was broken.
Yeah.
Broken.
Reunited at last.
Yeah. You could be happier about it.
What? I'm the happy guy today. You're the moody guy because it's cold out. It's cold.
Let the fans
it's so
judge.
Cold.
All right, sports guy. Whatever you say.
All right, let's talk about something everyone wants to talk about.
Now I do want to talk about real estate. I don't even care about
everybody wants to talk about the GSEs right now.
Yeah.
Right? They want to talk about will Fannie and Freddie go private? Is that going to happen? Is it finally going to happen now that Trump is in office?
I got to be honest. Your excitement just almost made me throw up in my mouth.
You got to make it exciting, dude. You got to make it exciting somehow for the listeners. What you think people are just like, oh,
I think you should get up and
interesting
clap your hands on the table.
So
right, we could talk about Fannie and Freddie.
Fannie and Freddie,
their
whole job has been to help provide liquidity in the market to ultimately help make housing affordable for folks. And if you don't know, essentially, Fannie and Freddie, they securitize loans, they sell them off as bonds to investors,
and they're government backed, which is a very important point. I feel like this is actually, I was wondering about this, right? You have some young brokers on your team now who are probably in their early 20s, just came out of college, right? Do a lot of them know that Fannie and Freddie are a quasi
I think so.
Public institution?
I mean, I think also it's one of these things that you have to learn or read about when you're taking your real estate exam, whatever that means.
For the younger guys, or if anybody doesn't know, Fannie and Freddie in 2008, when the housing market collapsed, went into conservatorship with the U.S. government. The U.S. government pumped $190 billion into them. They took it as preferred stock. They've made well over 300 billion in dividends, I should say.
Yeah. So if you think about it in a way, the U.S. government loaned 130 billion, they've made that back plus more.
That's right.
Right. But that's the dividends. That is not the principal. So 190 billion is technically still outstanding that they owe the government.
Yeah. And how much of the market do Fannie and Freddie cover?
About 70% at its peak, I think, during the GFC. And now we're down to, I think, around 40% or so.
So they're 40% of all the multifamily debt in the U.S.
That's right.
Yeah.
That's right.
So not
and we're talking multifamily there, right? 70% of multifamily during the GFCs and 40%, now, give or take.
So what was supposed to be a temporary conservatorship starting in 2008, it's now 16 years later.
Right.
Long time coming. Now they're talking about it being privatized, which would effectively mean the government gets paid out, and both the companies are public. Their stock price is like around $6 each.
Yeah.
Something Bill Ackman talks about, right?
Right. Well, I mean, look, right after the election just now, shares surged by 35-40%. Just based on investor optimism on the prospect that, maybe they do finally get privatized.
Mm-hmm.
And to your point, Bill Ackman, he thinks that this could elevate shares if they do get privatized to $30 a share versus where they're at right now, which is around like $6 a share.
It's 5x on your money if you're in today. But let's just talk about what it means for them to actually go private for a second, right? And let's break this down. So as it stands and as it's been happening since 2008, they have their own investors, but they have this backstop from the government, right? So the investors who are part of Fannie and Freddie, they know that if your multifamily loan goes out and, Fannie goes bust, Freddie goes busts, still the government will repay them and, the money will come out for these loans, right? So their loan exposure in these homes, they'll always be protected. They don't have to worry about the assets being fire sold or anything like that. If they go private, they lose that backstop, right? So now they have to raise more private investor dollars. Private investor dollars will be more expensive because they're not risk-free. It's not the government that could always print money. Right. So what are your 2 cents on that?
I mean, look, there's pros and cons. I don't think anyone actually knows what would happen. But I mean, it makes sense, right? I mean, when you have a public backstop, money's free, I mean, it's when you feel like the government's going to, bail you out or, back you up. Yeah. It's easy when it's real money on the line and it's your money. It's a whole other story.
Yeah. So inherently the interest that they would command is going to be a little bit higher.
Right. Because more risk for them, higher interest.
I saw some economists forewarn that like the cost for homeowners can go up by $730 to north of $1,600.
Yeah.
I don't know how they're calculating that. That seems like for the average payment to be more than double. I mean, that seems like a big big discount rate that they're using. But what else? What else are some of the implications that you think can come out of this?
Well, I don't know. I mean, one thing is just the repayment. I mean, I think that's important. I mean, at some point,
which repayment?
The repayment of the initial, $190 billion. I mean, and
so if they have the capital to actually pay back,
they should pay it back, right? I mean, I think that that makes sense. They get a liquidation preference. That is the government. So they're the first to get paid. I mean, I think I really don't know enough to be an expert here by any means, but I think generally privatization for the most part's a good thing as long as there's a little oversight here and there. But
the way I see it, it comes with a rise in the rates, right? So what makes Fannie and Freddie, you as a broker right now, you deal a lot in the multifamily market, right? And you deal a lot with this kind of GSE financing.
Right.
What makes Fannie and Freddie such a unique option?
You get better rates.
You get better rates.
Right.
Right. And that always came with the government backstop.
Yeah.
So if they have that gone, now they're competing with the open market.
But I think some healthy competition is a good thing too. And I do think that if anything, it just creates a little bit more competition because Fannie and Freddie are both going to be competing.
Yeah, I think
which they do now, but to a certain extent.
Yeah, I could see banks. I could see some regional banks or even kind of the big money centers winning on what I'm saying is like brand versus price.
Yeah. Right.
So if the prices are the same, you're probably more inclined to turn to your bank where you have your checkings, your savings, right?
Right.
Maybe your car loan, and now you'll go for commercial real estate financing, right? You go to the beast that you know.
Yeah. By the way, speaking of the beast, did you watch the Beast games? Have you seen that?
Is this Mr. Beast?
Mr. Beast?
No.
It's crazy. He basically does like a Squid Games Have you ever watched Squid
Oh,
Games?
dude, if you love that, you would love Squid Games.
So,
Have you ever watched Squid Games?
So I just watched Squid Games, which is just I've never seen anything like it. But I'm a little late to the game. I know.
If you haven't
it's like the
seen
most
anything
watched
like
Netflix show
you should watch Squid
ever.
Games 1.
Yeah, I watched
It's exactly like
I watched Squid Games 1,
Yeah.
and then I watched 2, and then I watched,
you watched
Mr.
Mr.
Beast, and it's just crazy. Anyways, I don't know how I got into that.
Yeah.
You mentioned Mr. Beast for some reason. That was
did.
weird. Why'd you bring that up?
Don't gaslight me. We don't. This is the Trump administration, boy.
Right.
We don't gaslight
Right,
anybody. In
so we just
25.
talked about the potential privatization of the GSEs with Trump, who's a huge proponent of it. Let's talk about some other implications that might come out of a new Trump presidency on commercial real estate.
Yeah. What do you got?
Well, I mean, the first thing is just kind of, if you look back at 2017, the Tax Cuts and Jobs Act.
Yep. The good old TCJA, as
That's
they
right.
say.
Yeah, everyone talks about TCJA. That's
Everyone's on my
TCJA.
mother.
Yeah.
My grandmother's constantly bringing it up.
So at the
dinner
time
table.
when it came out, it was just revolutionary.
Yeah.
Because of the tax benefits that was bringing to the commercial real estate market.
What's the biggest one that you could think of?
So opportunity zones is
Huge.
one, right? And essentially what happens is every state gets to choose different tracts of land that they want to encourage investment in. I know a lot of our listeners know about this stuff, but not everyone does. And in theory, it's a great idea, right? To spur investment in communities that need investment.
Yeah.
And in return for that, you get to basically offset your capital gains.
Yeah.
And so you can use it like a normal 1031 exchange where you can
defer your capital.
you can defer your capital gains
for 10 years.
But if you hold it for 10 years, in other words, if your up leg is into that opportunity zone and you hold that investment for 10 years, you can get out of that totally free of having to pay any capital gains. So it's a incredibly attractive tool for, as you can imagine, for tons of investors out there who are just, there are a lot of folks, if they sell, the recapture is so much that they might actually lose money. Yeah. So this is a way to just really
Isn't that crazy
help a brother out.
Yeah, it's the help a brother out tax.
Yeah. I've seen firsthand how the right platform can make all the difference for advisors and their clients. With decades of collective experience in investment sales, debt placement, and equity placement services, Gray Steel has built a culture where collaboration, relationships, and excellence power results. Backed by concierge-level infrastructure, proprietary technology, and an entrepreneurial mindset, the firm enables professionals like myself and our team to deliver tailored solutions, precision-driven pricing strategies, AI-enhanced insights, and exceptional value at every stage. Discover how top professionals are scaling their business and continually unlocking new opportunities for their clients at graysteel.com.
So that's one thing. The other thing is bonus depreciation. Yeah. And that's where, for certain fixtures, appliances, other sort of upgrades in a property, you can basically fully depreciate that cost.
100%. So you can take 100% of that depreciation.
Right.
So that,
I'm just throwing this out there, that washer dryer is $100.
Does it apply? Can you spend it on appliances?
I believe so. Yeah.
Yeah. And I know that you can do it to like structural items. So anytime that I think about depreciation, you could do this across commercial real estate. And part of what makes commercial buildings such a good investment is this bonus.
No, I think
you don't only need an opportunity zone.
No, I think it goes as far as, appliances. I think that's interesting. I mean, if you just think about it, you're spending $500 on, some appliances or a piece of a roof, and then that's $500 you don't have to, that gets taken off of your taxable income.
I'd be curious. We should look that up and see if that's how it works for the op zones, because I know that. So like I brought up the commercial
and that's bonus
buildings.
Depreciation I'm talking about, not the op zones. But the bonus depreciation, you can, there's something called a cost segregation study where you can segregate different items that are depreciated, and you can
which they do for the land versus the structure.
You can't do it for the land. You can only do it for the structure.
I know. That's why you do the segregation, right? But I always thought that the depreciation is for the money that you're spending on, like, You have to pump that money into the actual asset.
For an opportunity zone,
Yeah.
you do. And it's only applying to the actual, what we'd call an improvement versus the land.
Okay.
So, yeah. Anyways, so bonus depreciation, opportunity zones. I think those are two things that Trump will most likely try to push again. They're both kind of times coming up on them. In bonus depreciation land, 2026 is the last year where you can do it. And at that point, it's only 20% versus 100% depreciation.
Yeah.
So
it's huge. Huge difference.
I think there might be a good chance that he comes back in and starts it all over from the very beginning. Maybe we'll see.
For our young analyst friends, that really is such an important piece for your bosses.
Yeah.
That big bonus that they get at the end of the year. What better way to offset it than with your washing your dryer?
Well, it's got to be a qualified property, okay?
Yeah.
And it's got to.
I get all that. I would be really curious to see if somebody is well versed in the op zones. I'd love for you guys to message us and give us some of your opinions on what could be depreciated.
Yeah, I'd love to
see how egregious.
I'd love to have a cost segregation expert on the podcast, but I also don't want everyone to fall asleep. So
wow. Wow. Jack, good luck doing another deal, Jack.
Anyways,
what else? We're still on the topic of the TCJA, and Trump policies.
Yeah.
Right. So other Trump policies that we hear, some of his motives. So it's not called policy. Some of his motives.
Yeah.
He's got a really big motive. One that is getting developers shaking in their boots. I know you've been shaking in your boots. They say that.
I don't know what we're talking about.
Well, I'm going to tell you what we're talking about. Slow down, Jack. Jeez, man. He wants to impose a 25% tariff on Canada and Mexico.
Yeah.
Canada and Mexico are close friends. And we had a note here for what he wants to impose on China. I read that it was upwards of like a 60% tariff. But the tariffs on Canada and Mexico are going to make steel, aluminum a lot more expensive. A lot of timber comes from Canada also. So let's
obviously that trickles down. So, if that does happen, and, some of what Trump says, I think it's the art of the deal, baby. He's just trying to, start from a strong stance and maybe work his way down on that negotiating pole there.
Yeah. But, I mean, I know we're big on the ideal of American dynamism, as Andreessen Horowitz calls it, right? And like doing things in our backyard. He announced Stargate. He wants to spend $500 billion, building the expert data centers and all. But like 25% tariff on Canada and Mexico, pretty steep trickle through, right? And we know that. How does that get imposed, right? It's either the suppliers will eat some of that, but most likely it trickles down to your end buyer. And given where construction starts have been, like how slow they've been,
it's not going to help.
I definitely anticipate them staying.
Yeah, hard costs have already gone up through the roof for developers, from COVID, and this certainly wouldn't help. So we'll see what happens there.
Yeah,
kind of along the same line is just immigration, right?
Yeah,
and immigration policies, and
that's a good one.
Yeah, 13% of construction workers are, apparently undocumented workers. Different sources say.
Right, and that's just undocumented workers. I've also seen that a little less than a third of all the home builders in the U.S. use immigrant labor.
Yeah, so that means like they might be documented, but they're immigrant labor.
They, in theory, those people are safe.
Okay, yeah, and look, states like Texas, California, and Florida. I said 13% of construction workers are undocumented throughout the country. Those are more like 20%. Which is not a surprise. So
no, not a surprise at all.
So if he does do what he says he's going to do, and that's not great.
Yeah, so now couple these things together. You got increase in your raw materials. Even worse, you remember we had Alex on from Kubi.
Yeah, he was bringing that up.
Well, he was talking about the shortage in labor.
Yeah,
right. So which really applies here, and that amplifies.
Yeah, because he brought up the point. He was like, look around. Can any of your friends?
Can you say that any of your friends work in construction? Like, do any of your friends
know how to do anything?
Or do you know people who work in construction?
Do you know how to, hammer a nail. I don't
Yeah. So I think we already have a shortage of labor, and we have what we really have a shortage of is people, let's say graduating, like post high school, they decide to go to college. Generally, the people going to college don't want to come out and work in hard, called blue collar.
They want to do what traditionally are the high paying jobs.
Yeah.
Like being in finance.
Yeah.
And
which is, by the way, super debatable.
Dude,
and
you know what I mean? That's the image. And so I think, things need to swing back the other way, certainly to encourage the trades. But
yeah, I think if Trump actually leans into the, mass deportations, huge shortage in labor, and it's going to come fast. Like that's the tariffs take a little while for you to feel, but the
labor right away.
But the labor is right away.
Yeah.
What else on that roll?
Federal real estate.
Yeah. So this is interesting one.
So the GSA, which is the General Services Administration, manages all federal real estate assets. And they manage 370 million square feet. And, a lot of these buildings are really poorly maintained. I mean, a lot of them, walk into any federal building in your city, chances are it is total shit.
Sure.
I mean, it's, just.
I mean, as much as I love hanging out at the post office.
Yeah. I go to any library.
Yeah.
Right? I mean, go to any library. They always have a weird smell.
Yeah.
You know what I mean?
I don't know if, do you have any examples? I'd love to hear your examples.
I go to public libraries a lot. It's a thing I do. Every city I visit, I check that out. I mean, so that's honestly, I think he's bringing up some good points here. So he's considering selling 2/3 of federal office stock.
Yeah. And we're talking about things like, so I think for our listeners, when you picture the GSA and their holdings, picture all of Washington, D.C.
Yeah, basically.
For a very large
right?
part.
Yeah.
So I've dealt with the GSA many a times. And by the way, it doesn't always have to be, there's a couple of things that you need to think of. A, they own a lot of buildings, which isn't great, right? Because they just don't need them on their balance sheet anyway.
Right.
Also, the GSA is your counterparty for every lease that you sign with the federal government. So when you have like HHS or any other department that you're dealing with in your building, you're dealing with the GSA. So we're like DC is sitting on tons of these super decrepit office buildings that have, first of all, nobody in them.
No one's in there.
Nobody's in
That's
these
the
buildings.
other thing.
Yeah.
So, and that's goes back to, something else we're going to talk about, and that's just the return to office, which I know we've already talked about some in another episode, but I think it's all interrelated. A lot of this space just isn't getting used.
Well, we've got the new, what do we call them? Are they an initiative? The Doge.
The Doge. Yeah.
So, which you and me were laughing about this, right? Because as Trump got sworn in, I think it was at the same day or maybe the day before, Vivek Ramaswamy announced that he's leaving Doge, which in theory, if you're going to have a Department of Efficiency,
why have two?
You can't have two leaders.
Yeah, it did make sense from the beginning.
Yeah.
Be efficient.
So I thought that was pretty funny.
Well, so here's another thing I think is kind of interesting. The GSA we're just talking about that, controls all the federal real estate out there. Trump has already worked with them before. He worked with them with Mar-a-Lago, which I think is interesting. And he worked with
GSA
them
or the IRS.
Fair.
Might have been the IRS.
Maybe both.
Yeah.
And he worked with them with the Post Office Hotel in DC.
Yeah.
So he's no stranger to the GSA. And now he's kind of saying, hey, you guys, you're wasting money.
Yeah. And specifically what he was talking about was, so one of the first things that they announced, and he signed the executive order, 5-day work week for all federal employees, which, look, selfishly, me and my tax dollars say, yeah, of course. Like, go back to work 5 days a week.
Right.
Now, I'm in the office 5 days a week.
Are you?
I am.
I know you are. I'm just,
that's not a secret.
Yeah.
I think largely, like, a lot of the big companies are, right?
Mm-hmm.
At a minimum, it's 4 days a week.
Yeah.
Right. So also, I don't want the federal employees that, like, we're sponsoring out of our income
Well,
to be
that's the thing.
Not working in the office at all.
Like, right, when it's you,
Yeah.
But when it's your taxpayers' money that is going to pay their salaries, I think you want them in the office, which just goes to show you that if you're a big company and it's your money that you're paying to your employees, you probably want them in the office too.
I think it stings a little bit harder with the tax dollars because you want to see a correlation of people's productivity. Like you want to see that the government is using those dollars not to just pay some bureaucrat, but like, I want my roadways fixed.
Yeah, of course.
Right?
And you look around and they're not. So,
So is it taking you long because you're sitting at home and doing your nails in between meetings?
That's right. Because you had to go run that errand at 2 p.m.
I think it's a totally fair executive order. I'm definitely in support of it.
Yeah. And by the way, 2.3 million civilian workers work full time in an office, and more than 1 million of them are represented by unions. And I think that's going to be some of the real pushback they're going to get is just working with the unions, and you're actually implementing this, I think will be really hard. By the way, another side note, the GSA's original purpose was to cut government waste after World War II.
Isn't that so funny?
Yeah, so funny. I didn't know that. I think that's...
Well, this is what happens. And
over time, things start to get wasted.
If nobody has read Principles by Ray Dalio, or if nobody follows Ray Dalio, take one thing away from him. Ray says study history. Because what happens is
repeats itself.
It takes less than 10 years, right? Like just think about from us to a newer generation. It takes less than 10 years for so much of this information. And by the way, we live in information overload. So it's only getting harder to keep track of what's really relevant. But as the generation goes, you quicker and quicker forget what the purpose of some things that we set up were.
Right. It's
exactly like this.
It's insane.
It's so funny how, like, you're talking in 80 years, right?
Right.
How fast the GSA like switched purposes.
Yeah.
Right. And of course, it's a bunch of federal employees. Like, they don't want to lose their jobs. They're going to find new reasons to be relevant.
Sure.
And for the most part, we have so much shit going on in the world between, multiple wars, crazy potential civil war and dystopia in America, which I hope, we see goes away now as people are becoming more rational.
We'll see. I hope so.
You hope that that Doge can deliver on like a tenth of what they're claiming.
If they do, it'll be a miracle. So we'll see. I hope so.
I've seen firsthand how the right platform can make all the difference for advisors and their clients. With decades of collective experience in investment sales, debt placement, and equity placement services, Gray Steel has built a culture where collaboration, relationships, and excellence power results. Backed by concierge-level infrastructure, proprietary technology, and an entrepreneurial mindset, the firm enables professionals like myself and our team to deliver tailored solutions, precision-driven pricing strategies, AI-enhanced insights, and exceptional value at every stage. Discover how top professionals are scaling their business and continually unlocking new opportunities for their clients at graysteel.com.
And then I think the last thing that we could think of was just kind of the environmental policies, sustainability. Trump obviously not a huge fan of any of that. And
well, he definitely wasn't a fan of the Paris Agreement. Right. He's pulling out, claims that he's going to pull out of that. I think he ran on that before. And
he did. Yeah. And I mean, obviously there's restrictions on buildings and developers when it comes to all those types of things. So that's going to have some sort of impact.
Well, the tariffs are definitely not going to help in the ESG
I don't think
component of it. Right. Especially like, I know you and me looked at a lot of developers who would use like mass timber. Smack another 25% of that and delete a third of the labor.
Right.
You're not getting an ESG building.
Right. It ain't happening.
Yeah. I'm going to use something much less efficient to get my project done.
All right. Well, let's get into the hot renter markets right now.
Yeah.
I don't know. Do people get tired of these conversations? Like, what's the hot renter market?
I mean, we spoke about this before where it's like, it's never a surprise.
Yeah.
Right. But
I don't know. I was surprised by some of these.
Yeah.
This time Cafe comes out with this list.
Yeah.
Right. Every so often.
tell us about it.
So Minneapolis tops one of the top rental markets in 2025.
Which is funny to me. And by the way, if you're our listener and you're in Minneapolis,
You're
I love
cold,
you.
first
I love,
off,
yeah,
right?
you're
really
cold.
cold. We're sorry.
And now I know how you
Yeah,
feel.
yeah, it's cold here too.
So I love you and I care about you and I want to get you out of there. What can we do?
Right. Well,
what can we do
apparently
to
they want to
save
stay
you?
there because they're too
Yeah.
cold to leave.
So I ask, why?
Yeah.
Like why? Just why?
I don't know.
But yeah,
I don't
so
know the answer.
Minneapolis was at the top of this list. It's apparently the hottest rental market.
Atlanta and Overland Park, Kansas.
Yeah,
Those are,
and don't
those
you
are hot
feel
ones.
stupid if you're building in Florida.
Yeah.
People want to live in Minneapolis.
Dude, yeah, come on.
Yeah.
Don't just go with the masses.
Yeah.
Just because everyone else is developing there.
Yeah.
Midwest cities like Cleveland and Detroit.
Yep.
I think
Also super surprising.
it's an
right?
affordability thing too. They're just more affordable.
For sure.
You know,
Go to the middle of anywhere, like not encumbered by anything, and build a hut. It doesn't necessarily mean it's a great place for you to live. But yeah, Cleveland. I know some people building out in Cleveland. We have guests that are coming on the show who, or no, they're in Cincinnati. I get Cincinnati and Cleveland confused. To me, it's the same
Indianapolis.
place.
I don't know.
Yeah,
these
that's
places.
my elitist New Yorker shitbag talking.
North
but yeah,
Dakota, South Dakota.
Detroit. I've known about. I personally, I think Detroit is outside of New York.
Detroit's cool. I like
it's
Detroit.
the coolest city.
Yeah.
In America.
Well, that's a stretch.
No,
but
you heard
I think
it
it's
here.
cool.
It's one of the coolest cities in America for sure. Not saying I would live
It's
there.
wild to drive through Detroit and see the dilapidated homes that are empty now and stuff. I know that's getting taken care of little by little, and there's developers buying up a bunch of land there, and gentrification's coming.
There's people doing really cool stuff in Detroit. If Detroit hasn't been on your radar, definitely take a look. Around those dilapidated houses, there's I remember meeting a guy, Phil Kafka.
There's hipster coffee shops not too far.
There's definitely some hipster coffee shops, but there's very cool concepts. I ate at one of the best restaurants I'd ever eaten
in Detroit.
That was like truthfully surrounded by 10 abandoned homes. It was in the middle of nowhere.
Yeah.
It was an old gas station that got converted into a really cool restaurant.
It's a little shticky, but
there's people,
very cool.
look up people like Phil Kafka. I'm going to get the name of his project, who were building these, like, he had like metal containers where he was building like kind of flex living space.
Yeah.
I think he was
are
like
they
the
are
first,
they shipping
like,
containers or something?
They weren't
something
shipping
different?
containers, but they were like it almost looked like what you would see on a farm, like these like big round like storage houses, basically. And he would make really cool like share multifamily houses, kind of like Common would do, right? Where they would have multiple bedrooms, people renting, like they would take an apartment, you rent a bedroom, and then you get the common space. He was doing this in Detroit a while ago, and he was making it like really affordable.
It's doing well still.
I mean, I think he had done really well with it. And I remember this project happening definitely over 5 years ago. It was the last time I was in Detroit.
Detroit, it's a thing. And I guess, Northeast cities, there's some good stuff happening there with rent. I mean, Philadelphia and Queens.
Is there good stuff happening with rents? It's going up.
It's Rent Cafe.
Yeah.
Markets to watch.
Philly's an interesting one for me. I feel like Philly's been decimated by their own politics.
Rent Cafe has Philly and Queens, New York in the top 30.
Well, I can't argue. So, forgive me. I can't argue with Rent Cafe.
They know what they're doing.
Yeah. They do. I apologize. Forgive me, Rent Cafe overlords. How dare I question? What you say? On a anecdotal side note,
give it to me.
The one thing, as we were looking at these cities, I looked at like REIT performance, and I was just curious, and I'm very curious. Anybody who's a REIT analyst, I'd really like to get your take on this. I was looking at product focused REITs versus like geographical REITs. When I say that, like SL Green is predominantly they are
Office,
kind of
New York.
Yeah, but more so just New York, because now they're getting into residential and they're doing some other stuff.
Yeah,
right?
but then you have MAA, they're multifamily.
Correct. So I was looking at product, like JBG, another they're just focused on DC, but they have retail, multi, all that. And I was looking at like which REITs perform better. And the reason I was looking at this is because like we've been so focused. I feel like this whole year we spoke about politics affecting cities, and like every developer, every investor that we had on here had to mention, oh, I'm going towards red leaning states, or I stay away from this. Like,
right. Oh, and then some of them, they think they know something other people don't. Here, my secret is,
yeah,
I go to red states.
Yeah, I go to red states. Yeah. So the funny thing is, I predicted, I was like, well, naturally, the geography focused REITs are going to be doing so much better.
Yeah.
Because if you're investing in anything in a red state, like, you're killing it.
Right. So we're told.
Not the case.
Yeah, interesting.
It was actually totally for the asset class dependent. Like, so data center REITs had performed over 50%. They'd returned over 50%
so you're talking about
for the year.
These are asset classes, and they
they're spread out
across the
nationally.
country.
Yeah. And by the way, I don't know if they're across the country, but it could be like you're in 2 or 3 cities, whatever it is. But you're not geographically focused.
Sure.
You're not the guy saying, "Oh, I'm only betting on the Sun Belt." And
well, I mean, it's not a surprise, right? Like just talking about, like, you know, multifamily, Sunbelt had just so many deliveries come online over the last couple of years. That's going to impact things.
So that's funny. So I think that's, like, you hit the nail on the head. That's a big piece of it, right? Where it's so tough to focus on a geography, but yet the geography is like completely what has been influencing everyone.
It's almost like you're more diversified when you're national, right?
Yeah.
I mean, it kind of makes sense.
Yeah, and that's why you know, the real billionaires. Yeah. They don't diversify. They lean into the one thing that they like. It's true.
Yeah.
Yeah, that's how they become successful.
All right, let's talk about something that's a little bit on the somber note. And it's the fires.
Yeah, something near and dear to my heart. Although I am a New York shitbag, I actually I really love California. I really love Los Angeles. And as do a lot of people, and we have a lot of friends out in LA.
It's impacted so many people. Yeah. I mean, you know, if you're one of the lucky ones to, you know, have not lost your house, you're displaced some, you can't go home. Your friends, your family.
So there's an unfortunate theme that we've been talking about that's already been affecting the country. Places like Miami, places like Arizona have seen really high rising insurance costs, and insurance has always been problematic in California. I think it's gotten
crazy
10 times
across
worse
the
now.
country. Yeah. Florida, Texas, when you're, you know, closer to the coast, and of course California. It's out of control.
So the Treasury Department did a study where they found out that homeowners paid an average annual premium of $2,300, and I believe this was for 2024, which was 82% higher than people in less exposed area. And going back on this note, it was for people in in areas that have high risk of climate related damage. So exactly what we're talking about: LA, other super hot, dry places like Arizona, flooding in Miami. Those markets are paying 82% more than someone, say, Oklahoma City.
I mean, look, it makes sense, right? Yeah. I mean, there's more risk. And you know, insurers aren't doing this out of the goodness of their heart. Yeah.
We definitely know that. And we're seeing that with a couple of insurance firms who are now.
That's what's crazy, right? Yeah. It's like, whose job is it to help compensate people who, you know, tragically lose things, right? But State Farm and Allstate pulled out of California. Yeah. I mean, look, it's a lot to underwrite for them. How do they actually make money?
That's right.
You know, because of that, you know, California has their FAIR plan, which we'll talk a little bit more in another couple of minutes about. Okay. But that's kind of like the backstop. That's the state's backstop to still provide some level of insurance to some folks.
It's the Obamacare equivalent of insurance.
Yeah, Florida has their version of it, and they're all getting tested. But
you said that you mentioned to me, at least offline, that we're seeing property values starting to decline there, right? So in these high risk wildfire zones. I mean, that's an interesting take, right? That the values are declining. Like, I would think now that there's unfortunately so much less stock in some of these areas.
Who wants to live there? I mean, how do you...
Well, it's a weird balance, right? Because it's going to, on the one hand, you have to rebuild it now, right?
Right.
When you rebuild it, it's going to cost more. So when it costs more, how is the value declining, right? But I guess you do have a big portion of the market that's probably thrown their hat in and said,
well, I think building codes have to be totally re-envisioned.
Sure.
You know, fire protected roofs, you know, barriers between, your home and anything that's flammable.
Yeah, it's interesting that we haven't seen that like in such exposed areas.
As much as you should.
This isn't a new
Yeah,
thing.
it's weird. And
California's had fires.
You've
for
seen like
decades.
occasionally there's like one house by itself on a block that's fine, and that's usually why. So I don't know. It's pretty interesting, and I know insurance rates are getting out of hand.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free. Yeah. How many of those people are underinsured? Imagine that. Like that's a pretty common issue. And like you take a place like Palisades Park, right, which got decimated the hardest, I think, in LA so far. So many of those homes experienced such a boom in their property value, right, that when the person or the family who got that house bought it for a tenth of what the market is pricing it at today, what are the odds they change their insurance policy, or they could even afford their insurance policy to cover what those homes actually cost?
Right.
There was the instance of the one mother in LA who had an $800,000 mortgage on a newly renovated home, which burned down. Her insurance sent her a check for about $200,000, right?
Yeah,
a quarter of the price.
Tough.
What do you do now?
I don't know.
You can't
so
get anywhere.
The California Fair Plan that we had kind of mentioned as kind of the insurer of last resort, that's, taxpayers' money essentially, right? Mm-hmm. They've obviously seen a huge increase in policies because, State Farm and the like have pulled out. And, the number of homes that are covered by it they've more than doubled. So this is a lot of risk that they're taking on. Sure. And so, just some interesting stats and numbers I just think it's hard to kind of wrap my head around. But, as of the beginning of this year, they're thinking that there could be up to 30 billion in losses.
Yeah. By the way, it's way too. So many people have thrown out these numbers.
Let's go with it. I mean, because it wouldn't surprise me. But there's only 377 million available in that fair plan to pay out on those losses.
Yeah, that's the interesting piece, right? Even if it was 10 billion, right? It would take the lowest end of that number. It's such a stark contrast between what you have available to pay for those claims.
Right. And they do have reinsurance. Yeah. Right. The insurers.
That's right.
Insure.
That's right.
At 5.7 billion that they have, but that comes in way below 30 billion.
Right. In the best case scenario where you're at the lowest end of property damage, there's half of that amount.
Yeah. So I don't know what happens. Yeah. Right. I mean, we're like kind of in an uncharted territory.
You're going to get a lot of immigration out of there.
Well, I also think this becomes sort of a public-private debate. Whose job is it to pay for these losses? Is it the government's? And if so, does someone in Texas, say the federal government comes in and helps out, should they have to be the ones that are helping to subsidize paying for someone who loses something in California who knew that that's probably not a great place to build on?
By the way, I saw like a federal aid package go out already. I'm not sure if this was already, Trump's doing or if this was Biden's doing, but it was like maybe $1,000 for everyone who got affected.
Good luck. They'll buy you some.
Just fucking keep that at that point.
They'll buy you some shoes.
Your tax implication is probably so much worse than what that does for us.
Anyways, it's a lot to come there.
Yeah. So obviously love all of our friends in LA. I hope to see you guys all okay and on your feet. Let's end this on some outlook for the new year, right?
Yeah. Financing's back.
The year of the snake.
I think everyone was like survive till 2025 and now it's stay in the mix till 2026.
Schmucks. You survived. Now pay the price.
Yeah.
You know how much I hated that survive till 26.
I still hate it. I'm I'm going
Such
to this
malarkey.
conference next week, and it's just that's all. It's going to be the same.
What's the conference next week?
NMHC? It's National Multifamily Housing.
So you're telling me
Council.
if I'm at NMHC, I could see Jack Stone from No Cap by Siri Daily?
Yeah.
Wow.
Yeah. If I get
that's enough for me to go.
I know sometimes I have to have bodyguards when I go to these places because
Dude, you're getting too good for the show.
Anyways,
so lending's back.
Lending is back.
The $22.5 trillion behemoth. What do we got there?
I think for starters, like let's just think about the mountain of debt that is maturing.
Oh, I'm thinking about it.
So
how big's that mountain?
I think it's
a big mountain. There's about $1 trillion that
sounds right.
Are coming in a wave of defaults potentially in 26.
Yeah.
But overall, we were saying that lending's back. Lending is back. There's more than a 25% increase year over year for 24. We saw nearly $540 billion get pumped into the market. That came from the Mortgage Bankers Association. Sweet. A lot of debt funds. Ton of people are out there.
Debt funds are filling in again.
Yeah.
I think there is some more liquidity getting pumped out, and people are ready to do deals, and they got to keep the lights on. And like we were just talking about, the mountains of debt maturing.
But notably some absolutely massive loans.
Yeah, which is a good sign,
saw.
right? Like what are some recent ones?
Yeah, so October, Rock Center, right? Tishman Speyer landed $3.5 billion, 5-year loan from, there was a syndicate, but it was mainly Bank of America, Wells Fargo. That was a crazy one.
In Miami Beach.
Your favorite place.
Love that place.
Yep. They
1.2 billion refi.
Yep, huge.
Yeah.
Biggest one I've seen, which is really, I was going to say it's not a pissing contest, but it most certainly is amongst New York City developers. RXR and TF Cornerstone, they have a site that they're trying to build, 175 Park Avenue, which is supposed to be the newest super tall. They made sure it's bigger than One Vanderbilt. They're looking, the loan size is so big that they're looking for federal aid. They want to get some of the infrastructure plan money.
Stop.
Because they're gonna have MTA.
Yeah, because the subway doesn't need help or anything.
Well, they're gonna use some of that towards connecting to the MTA and like
but doesn't the subway need like $3 trillion or something stupid?
Well, then they better ask for it because they're asking for $6.5 billion in loans. So I want you to compare this to One Vanderbilt, which has now become the forget gold. It's the diamond standard in New York, right? It's what every nice building for the next 15 years will be compared to One Vanderbilt. That was they sold 11% of their equity stake to a Japanese trust called Mori very recently in 2024. The building was valued at $4.7 billion. That was the total valuation for the building. So assuming that you're not getting 100% loan to value, they're asking for $6.5 billion for this one project, this one super tall office project. So essentially, you're going to have to take all of the offices ever and stick them in this one building.
Meanwhile, we have all this office space that's just totally unusable.
Well, you don't hear on Park Avenue and Madison. I mean, it's
your pockets.
Tight. Yeah, you got to know your pockets. Yeah. But on that note, office is still getting some pressure, right? Yeah. What's the office market looking like?
You tell me, Mr. Office Man. I think that. We know that the higher end product in cities like, New York and other core markets are doing well. Yeah.
So overall, right, we always have to look at these like national averages and these segments that are lumped together. The values plummeted about 50% since 21.
Yeah.
Right? So since COVID, your general CBDs have dropped 50%. You have vacancies that skyrocketed.
But meanwhile, these like trophy office buildings, like I mentioned, I mean, they're commanding huge rents.
Yeah, huge.
I mean, it's just two different worlds.
Yeah, completely. You're getting, we're talking about One Vanderbilt. I think on their very top floor, they signed a lease north of $300 a foot.
Wow.
And then you got the maturities, right? So going back to the maturities, $1 trillion of maturities set to come in by 2026.
And look, average borrowing costs raised, 2021, it was like 3.5%. Now it's like 6 3/4.
Yeah. And what's really interesting is like so much of the focus was on office and commercial in that number, right? It's not just office, retail and other commercial uses.
Right.
And we know that multifamily has been under pressure and that lending's been under pressure, especially if they take the GSEs private
Mm-hmm.
and that happens soon. How much pressure are they going to feel?
That's a good point.
How big are those defaults going to, like those multifamily deals? And we were talking about it with Rich Byrne and the end of our last season. Like they're doing razor thin margin deals, right?
Right.
It's the difference between 50 basis points for some equity investors between their debt and their entry caps, right? So if your rates are going to stay the same or they go up 50 basis points,
makes a big difference. That's your margins.
Smacked, pal. So overall, 2025 office stays down. I'll make a prediction. I think office valuations come up because if the tariffs come in place and it gets so much more expensive to build, any form of the deportations happens, the labor markets get cut. There's already no starts in office. There's going to be even fewer negative starts, however that can happen in life. You're going to continue to see the office workplace come back to life with this 5-day-a-week return, federal employees coming back, office rates go up. Multifamily gets smacked in 25. End of 25, I believe multifamily gets hurdles of debt. If the GSEs get privatized in 25, even faster. That's probably like the beginning of 26.
It's all market specific, and you know we've talked about the markets that have been overbuilt versus the markets that don't have enough.
Don't be a politician. I want to hear who's going to do well.
I'll come back after NMHC. I'll tell you all the gossip.
Fine, I'll take it. I'll take it on that.
All right. Well, cool. It's good catching up. Yeah. It's okay. All right.
Yeah.
All right.
Room for improvement.
Next time.
Yeah. Buy a hat.